Warren Buffett's stock market indicator is sending us a major warning signal, and it's been sending us this signal for quite some time now. And what this signal is telling us is that the stock market is going well past its danger zone and becoming way too overvalued, which might indicate that it's time to sell stocks because the stock market is getting overvalued. In today's video, I'm going to be taking this Buffett indicator head on, and I want to be entirely clear. It is not my goal to disrespect or downgrade Warren Buffett. He is my idol. I don't think I would be sitting here today if it weren't for him. And I have a very good guess that you guys wouldn't be watching this video right now either if it weren't for Warren Buffett. I have great respect for that man, and me attacking the Buffett indicator head on is nothing about downgrading what he has done or what he has accomplished. It's just going to explain to you why I think the Buffett indicator is somewhat broken because of different shifts that have taken place in the system. On this YouTube channel, we've done a great job of attacking different economic indicators and kind of dissecting those and telling you why they might look worrisome, but in actuality, they're not. But I have yet to really talk about valuation. And that's the biggest comment I get right now is, okay, Rex, you've been right about all of this economic stuff, but what about valuation? Based on anything we look at, the stock market is trading for a premium that we've only seen in the tech bubble and in 1929 before the Great Depression. What say you about that? So that's what I'm going to be talking about in today's video. If you missed my most recent upload, I kind of sneakily uploaded it at like 10:30 p.m. a couple nights ago. Click the top right-hand corner. It'll open up in a new tab and go watch that video after you watch this one. Leave me a comment down below what you're doing in the stock market. I'm always curious, and also let me know if you agree or disagree with me about this video. And on your way down there, hit the like button and subscribe button. Helps me out tremendously. We have one of the fastest growing stock market YouTube channels on this platform, and it means a lot to me that you guys even are just watching this video. Without further ado, let's get into this. So on the screen now is a chart of the Buffett indicator, and it tells you what it is. It's the total value of the United States stock market divided by the total United States GDP. And that gives you a ratio. Right now, or at least as of June 30th, that ratio was 202% market value to GDP, which is 63% higher than the long-term trend line. That might sound like a lot of confusing words that are mashed together. All it means is that based on this indicator, the stock market is at least 63% overvalued. And again, this is an indicator that Warren Buffett himself came up with, and it's an indicator that Warren Buffett himself uses. So that's why Wall Street and really all stock market participants assign so much value to this, because the greatest investor of all time invented this and uses it. Now, most people, again, look at this indicator and say that it's indicating that stocks are overvalued. However, based on my research and based on my opinion, I believe that this is just indicating that people are willing to pay more for the assets in the United States of America. It doesn't necessarily mean that those assets are overvalued. Let me discuss this a little bit more in depth. I'm going to come back to this chart a lot in today's video. All it shows us is the yearly percent change in US GDP going back to the 1950s. But when we get more granular and really study this, it tells us a lot more than that. We can go back to the late 1900s here and see that the United States GDP growth or decline was very, very volatile and very unstable or unstable, whatever the correct term is there, where on any given year, the GDP might grow, at its best 13% year over year, and at its worst, decline 3% year over year. And based on this chart, it looks like it was really anybody's guess as to what the United States GDP might do on any given year because it was so volatile, up and down every single year. Whereas you can see more recently, since the 1990s, the United States GDP growth has been much less volatile and much more stable. Another way to put that is the United States GDP has become much more predictable than it was in the late 1900s. This is for many reasons, but this chart actually shows one of them. The gray bars are the different recessions that have taken place in the United States economy through the years since 1950. You'll see that the bulk of these recessions took place again in the late 1900s, and very few have taken place since the 1900s. This is a very important point. Recessions have become less frequent shorter in duration, and less harsh than they ever have been historically. To give you some real data about this, I have this written in my notes over here. We've had 34 recessions since 1854, but only 5 since 1980. And between 1960 and 1989, we spent 59 months in recession, but between 1990 and 2023, we've only spent 36 months in recession. And the most recession that we got because of the great virus crisis was actually the shortest recession on record. So why would this be and why does it matter? First of all, if our economy is much more predictable, less volatile, and more stable, it means that investors naturally are going to be willing to pay more for assets in our country. You are taking direct investment risk out of the system. But as for why recessions have become less frequent, shorter in duration, and less harsh, it's primarily because of things like the FDIC, which installed insurance on consumers' bank balances, where historically, if banks failed in our country, us people would potentially lose our life savings. And it really wasn't until 2008 that the FDIC insurance was upgraded to the current, I think it's $250,000 of insurance on bank deposit balances. Further, it's also because the Federal Reserve has been able to learn through history how to handle different financial crises or crises that happen in our system. Another way to put that is the Federal Reserve has learned from history how to better manage the country's money supply. All of these factors lead to, again, a much more predictable economy, which means investors naturally are going to pay more for the assets in the country. If recessions are happening less often, they're getting shorter in duration, and they're less harsh, it means that the risk of bankruptcy for any given business in our country is going down dramatically. And again, this is a shift that's taken place over the last 2 or 3 decades. This isn't something that was true back in the 1900s or even before that. Now, another thing at play here is that our economy has become way less interest rate sensitive. And that also means we're going to see less recessions, and those recessions won't be as harsh. This all plays and feeds into each other. The reason I say this is because during the 1950s, goods made up basically 2/3 of our economy. Today, that is down to 1/3 of our economy. And back in the 1950s, the services sector only made up 1/3 of our economy, but today it makes up basically 2/3 of our economy. So the goods and services sector of our economy have completely flipped each other, and our biggest corporations right now in the United States are much more focused on services. We can even look at consumption as a whole. United States citizens and companies are purchasing many more services today compared to the amount of goods they're purchasing. Again, this is a direct difference or dichotomy from the late 1900s. These two things have flipped each other. We can go a step further when we can look at employment. The goods producing sector of our economy only employs about 10% of the total employed people in our country. That is down from 35% in 1950. These are structural shifts that have happened in our economy that make our economy way less interest rate sensitive and at risk of seeing recession. The reason for that is because services producing, consuming, investment, and employment really, it relies way less on debt than the goods sector does. Services producing companies are way higher margin than goods producing companies. They have way healthier balance sheets than goods producing companies, and they have, it's in the same tune, but they have way less debt than goods producing companies. Again, all of this feeds into our economy is way less interest rate sensitive, and we have much more of a buffer just because of the way our economy is pieced together today when it comes to our risk of seeing a recession. Now, to prove some more of the points that I just made, this list shows you the largest companies by market capitalization in the United States of America. Most of these are services-focused companies. Most of these don't produce goods. Most of these are tech companies that have very good balance sheets, higher profit margins than ever before, and way less debt on their balance sheets. And they employ so many millions of people in our economy. We have Apple, Microsoft, Nvidia, Google, Amazon, Facebook or Meta. and Berkshire Hathaway's up there, Broadcom, Tesla. The list goes on and on and on. Bottom line, our companies today, the largest companies in the world, are no longer these industrial giants that have razor-thin profit margins that are at risk of bankruptcy and have very limited ability to grow because their balance sheets are horrible and they're highly leveraged. We have companies instead that have tons of cash on their balance sheet. They employ millions of people. Their profit margins are incredible compared to historical standards. And that is a big shift when it comes to the risk of investing in our economy. So that kind of explains why I think rightfully so, investors are paying more for assets in our country. They're paying more of a premium to purchase these assets because the risks in the system have declined through the years. Now, there's another flaw with the Buffett indicator. You'll notice that the Buffett indicator is simply the United States GDP. This is a problem because if you go through this list of customers here, they have a lot of international business that some of which is not factored into the United States GDP. So that makes this indicator also look somewhat misleading because you're taking just solely the United States stock market value and you're comparing it to the United States GDP. But a lot of the stocks in the United States stock market have massive international operations that a lot of which doesn't really get factored into the United States GDP. So whether you're looking at Shiller PE ratios or the price to sales ratio, any valuation metric you really look at, compared to history, looks like the stock market is way overvalued right now. But I would encourage you to, again, think kind of critically about this. Why would that be? Is it a legitimate thing that investors should be paying more for the assets in our country today? I believe the answer to that is yes, based on all of the structural shifts that have taken place, making our economy much more predictable and also much healthier. Now, I'm sure there's going to come a day where we have another huge depression in our country. And it could come as a result of the federal budget deficit. It could come as a result of the government having to print more and more and more and more and more money to a point where if the Federal Reserve prints more money to stimulate the economy, those dollars that they print are worthless because there's so much money in circulation already. That is a legitimate risk. But that is a risk that I don't believe I'm going to see play out in my lifetime. Could it play out? Absolutely. That's why I own some Bitcoin. That's why I think it's smart to own some gold or silver. That's my hedge to this. But ultimately, if the economy continues to grind higher and do well and grow as a result of a productivity boom, the United States is going to take in more money in tax receipts because of that increase in productivity. They wouldn't even have to raise the tax rate to take in more income if people are making more money as a result of a productivity boom. I personally do think that AI is going to power a roaring 2020 scenario. So far, the 2020s have gotten off to a really good start when it comes to that thesis. And the last note I want to make here is Warren Buffett himself has kind of backtracked on his own indicator, where he has been on record calling it the best single measure of where valuations stand at any given moment, to hesitating to endorse any single measure as either comprehensive or consistent over time. So he's even walked back his language in regards to his own indicator, although he still uses this indicator and points to it at times. Lastly, another popular comment I get on my YouTube channel is, Rex, just look at M2 money supply. And this is the chart they're looking at that shows M2 money supply absolutely cratering. And this is a problem for me personally, because this is the percent yearly change. You're looking at the M2 money supply on a year-over-year basis rather than looking at the whole picture. Usually when M2 money supply is falling, it means we're due for a recession, or dare I say, a depression. But what these people fail to realize is despite M2 money supply kind of, I would say, normalizing or decreasing over the past few years, money supply is still trillions of dollars higher than it was prior to the Great Virus Crisis. Trillions of dollars. And we printed trillions of dollars. It's just natural to see some sort of normalization when it comes to the M2 money supply after you print so many dollars. And even so, it's just simply not true anymore that the M2 money supply is falling. You can see on this chart almost clearly, it looks sort of flat, but it is increasing over time. M2 is the red line, and all deposits at commercial banks is the blue line. Both of these are rising. I am not concerned at all about the M2 money supply. Now, if you made it this far into the video, I just want to say thank you. It means so much to me that I get to do this for a living. And if you want to take it a step further, I have a paid monthly membership. It's not a requirement, but I am self-funded and I am entirely independent. I do my own research, and my monthly members really help support me every month. So if that interests you, if you want to go a step further, you can look at all the awesome perks you get by hitting the join button down below, or you can hit my Patreon link in the pinned comment. Again, I feel like I do a lot of different work and analysis than any other YouTuber out there. And really, since 2022, we've had a tremendous track record. Hopefully, I'm going to continue that track record. Maybe it means I'm due to be wrong. But yeah, if you disagree with anything I said in today's video, please comment it down below. I love having that sort of discourse. I'm not scared to admit when I'm wrong or when I slip up and say something that's incorrect. In fact, I've done so in the past. I am wrong. I'm human. I don't get everything correct. So please comment down below. And if you enjoyed this video, hit the like button for me. It helps spread this video out to a wider audience. I'm not really sure how many views a video like this will get because it's so niche of a video talking about the Warren Buffett indicator. But I hope this video helps you guys out. With that, have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.